Welcome, everybody. We're just loading people in, so if you give us a few seconds. Welcome, everybody. My name's Mark Malcolmson. I'm one of the Fred board members, and I'm your host for this evening on one of our Nexus events. We do these every month, and we bring a great thinker from all parts of the world, and tonight is no exception. In fact, delighted so many people have kind of signed up this evening. Depending on where you are in the world, whether you're in a very wet and miserable London or you're in a bright, shiny other parts of the world. James is in what looks like a beautiful part of British Columbia. So the nice thing about Fred is it brings us from all around the world. And I know some colleagues will now put up that they're actually not just in Canada or the United States. We've had people from the Philippines and people from Australia kind of dial in from the middle of the night in the past. So we are delighted for you, wherever you might be, for joining us. Fred's purpose is ethical and inclusive leadership. We look at all aspects of leadership, and we bring speakers together to talk about different aspects of leadership. And one of our partners in our project is Sworder Business School in Vancouver in British Columbia. And huge thanks to the team there, but in particular our great friend Bruce Weisner, who is the director of the unit in executive education there, and is a huge supporter of Fred over the last decade. And for those of you 6 months ago, Justin Bull spoke at this event, and we're delighted to welcome another great Sworder academic with us this evening. So the format for the next 55 minutes or so is I'm going to invite James to speak and give an informal talk. We are going to use, because we've got a number of people and we find that this is the best way to make sure that we kind of capture themes, etc., is if you want to ask questions or if you have thoughts or observations, can you please use the Q&A, not the chat box, because if we try and duel between the chat box and the Q&A, that often gets quite complicated. So if you can use the Q&A and put in any questions you have while James is speaking or during the Q&A session, which I'll moderate afterwards. I'll be moderating that when James is actually speaking. So the specific things that come up, I'll have an idea of where we're going, etc., etc. So we'll do it. I apologize, slightly artificial because you don't get to ask him directly. It's not highly interactive in that sense, but I'll do my best to do right by you if you've got some really intelligent kind of comments or conversation starters. And as I said, I'll try and find common themes from what might come through that. So welcome everybody on board. And without further ado, I'd like to introduce James. So James Tansey is Associate Professor at Sworder Business School at the University of British Columbia. He's a great friend of Fred's. Before the pandemic, we did Nexus events in person, and James did a really excellent session for us in London, I think 3 years ago now. I've completely lost track of time. I was thinking it was last September, but I realized actually it wasn't. And James straddles both the academic world and the practical applications world. We're going to talk about ESG tonight, but impact investing is very much his area, and he looks at both the academic side, but he's very, very active in advising organizations about how to make the most social impact on the way that they invest in the world. And he is chief executive of Canvas Impact Advisors, and works across the world, really encouraging people to think very carefully and very cleverly about how they might invest. Now, one question you might ask, which I think will become self-explanatory when James talks, is, well, so that's investing. What's that to do about leadership? Well, the great thing about UBC and the great thing about James's work is that you tie in how people lead to how they act. And that impact investing and looking at what the consequences of what you do is very much a facet of leadership. And it's a facet of how organizations are looking both in terms of the way they work with their staff and their stakeholders, but also where they put their money. And if they're putting their money in places that can make a difference to the world, then that's something that we at Fred wholly support. So really, that's kind of where James is going to take us this evening. So without further ado, I'd like to welcome my great friend James. And you'll all think he's Canadian, but he's actually British. He aspires to be Canadian, but in reality is one of us. So James, welcome. I will kind of hide myself and then reappear when James is finished. But over to you, James.
Great. Thanks, Mark, for the introduction. And thanks to all of you. I know we're crossing time zones here, and for some of you, I'm keeping you up a little bit later, but I hope I can provide something that's exciting and engaging over the next 30 minutes or so. So I've been involved in the impact investing space really since before it was fashionable, starting around 2006, 2007. We built a center at Sorda to look at social innovation and impact investing. And what's really exciting, what I'm hoping to share with you today, is the evolution of that sector from a sort of niche, family office-led, private equity-driven sort of boutique investing focus that sort of overlaps with philanthropy to some extent, to a sort of increasingly mainstream sector and cross-cutting both internationally and within domestic markets. So a really sort of interesting evolution. I will touch very quickly on sort of introductory elements and driving forces behind impact investing for those of you who aren't familiar with the terms. But the sort of meat of the presentation is looking at some examples and then really some of the trends that we're seeing. I have the great privilege of working in a place that allows me to both teach in a traditional way within the classroom setting, to undertake research, but also to be very active in a leadership role within the community. So when I talk about stories from the front lines, unlike many academics who get to sort of sit back and watch the stories evolve and then account for them in retrospect, I'm very lucky in that I get to kind of shape the contours of some of the movement and direction in impact investing. That's been very exciting over the last 4 or 5 years. Just by way of a little background, our center within UBC is called the Center for Social Innovation and Impact Investing, sort of S3I. We also set up a training academy, a social innovation training academy, which is really focused from a sort of leadership perspective on training the next generation of young graduates leaving business schools. So what we found is that students come away with very strong technical skills out of business schools, but very limited practical skills. And we have social ventures that have real capacity challenges as they start to grow and evolve and raise capital. And so the Social Innovation Academy takes on a very competitive basis the top graduating students in Canada out of business school and public policy programs. And it gives an opportunity to work with social ventures to refine from a sort of experiential basis and apply what they've learned in the general sense in business schools to the emerging social sector ecosystem and social venture ecosystem. So if you're interested in that, within the slide here, there's a link to the Social Innovation Academy. This is our most recent annual report just released this week. It's part of how we see the university contributing to investment in the next generation of leaders particularly within Canada, but increasingly looking internationally. And that's really about combining what they learn in the classroom with the opportunity to engage in experiential projects that directly benefit early stage social ventures. I'm also CEO of Canvas Impact Advisors, a company I founded a few years ago. In that work, our primary role is supporting both institutions and family offices and investors that are coming into the impact investing space. And what we found is that there's a lot of passion and sort of emotional engagement with solving problems through social and environmental businesses. And many entrepreneurs and institutions would sort of fall in love with the idea of an impact investment without really doing the same kind of due diligence they would do for conventional investing. So really what Canvas Impact Advisors does is say, let's step back and understand your goals and objectives. Let's understand how within, let's say, water, sanitation, and health, you could have the greatest impact in terms of achieving SDGs or solving problems within communities around water and sanitation. And once you've done that top-down view, then you start identifying and evaluating ventures relative to their effectiveness. So it takes a sort of investment research-led discipline that we see in many other sectors and applies it in the impact space. And that's really the sort of infrastructure that we built around that business. It's useful, I think, just to clarify where impact investing sits within the spectrum. Many of you will be familiar with the rapid growth of ESG, so environment, social, and governance activities associated typically with publicly traded companies, but not exclusively. That's certainly where we see the most activity. And in Canada, over 50% of publicly traded companies have some form of ESG screening. This is a kind of natural extension of a lot of the work that's been done on corporate social responsibility and reporting. In Canada, that the ESG coverage now is $3.2 trillion of public equities in Canada alone. So it's a really important force in terms of changing conventional businesses so they limit the unintended consequences of their activities, act in ways that embrace equity and diversity. But in the end, these companies are still producing mainstream products. They might be a bicycle manufacturer, they might be a ball bearing maker, they might be a fintech service. And so ESG is sort of the layer that wraps around conventional businesses. Impact investing is different in that the core purpose of a venture is a strong social or environmental purpose. And historically, there's been a clear line between what counts as ESG and what counts as impact. What I'm going to suggest today is that line is blurring quite a bit. But an impact investment, an impact venture, really has to have a clearly defined, intentional core environmental purpose or mission. They've typically been, or more often been, private companies. They operate along a spectrum, which I'll touch on in a moment. But it's really the sort of beating heart of the corporation has a social or environmental purpose, and that's what makes it interesting in some ways. It also often intersects with philanthropy, and we'll see a little bit of that as a driver at the moment. But philanthropic foundations and organizations have played a key role, right up to the scale of the Gates Foundation in underwriting impact investing ventures on a private basis, using their philanthropy to de-risk, in a sense, some of the early days and years of impact ventures. So this is the standard definition: investments made into companies, organizations, and funds with the intention to generate measurable social and environmental impact alongside a financial return. So this is the idea that's now been well tested in the context of ESG, that there isn't necessarily a trade-off between environmental returns and financial returns, or social returns and financial returns. There's intentionality built into this definition. You have a clear goal. It's not sort of an incidental byproduct. It's core to your mission as a company. But there is a goal of also generating a financial return. Now, a key point that I've learned over the years here is people obsess a little bit, perhaps too much, about meeting market rates of return, which are often advertised as 15 to 20%, but in practice are often much lower. There is a sort of bifurcation in impact investment. On the one side, you've seen organizations, funds achieve market rates of return and make that their primary mission. In other cases, you have an almost sort of deliberate goal of blending in philanthropic funding, using foundation endowments, not necessarily with the goal of making 8, 12, 14% returns, but with the goal of making a difference through a revenue model, but actually being able to get their capital back. And the sort of thought experiment here is, if you're If you're a philanthropic foundation and you grant the money to an organization, you give it away, it's 100% loss effectively. You never see that money back. If you're able to find a revenue model where you can use your endowment capital, even if you get your capital back and 0% return, that's 100% better than granting. So there is a bit of a sort of a blind spot here where people get caught up in the idea that all impact investments have to make market rates of return. But impact investments that are driven by foundations will be perfectly adequate if they get 100% of the capital back, or arguably even if they get less than that back. That's still a very powerful force. And what that means is you're investing in platforms that have self-source revenue, that support income, asset development within poorer communities. You can imagine scenarios where a foundation could lend to support social housing initiatives, for instance, with expectations of low rates of return that just meet their endowment's goals, but have an enormous impact by being able to leverage their endowment capital. Again, this is another commonly used spectrum in here. I'm not going to go into this in too much detail. This is more for sort of follow-up if you want to read it. But we're used to thinking about the two ends of this spectrum: operational charities, which meet charitable goals and interests, and purely commercial enterprises, which are profit maximizing or profit optimizing businesses. Within that, we have what we're all probably very familiar with, which could be an enterprising arm of a charity. So, the aquarium in Vancouver has a shop that sells products and makes money. It runs like any other gift shop does, but its mission is to support the goals of the charity. You can have enterprising nonprofit structures, which are designed to generate at least some surplus that can be reinvested in communities. In Canada, particularly in the prairies and in Quebec, cooperatives play a massive role in the economy, and arguably their mission is more tied to the activities of the membership. And then we have where most impact investment sits, which are in the social purpose business category. And to the right of that, you have ESG, socially responsible businesses that donate to charity. None of these I would really consider to be impact investments. So it's really the sort of from enterprising arms of a charity through to social purpose businesses where we focus on these kind of impact investing business types. So I'm going to give you a couple of quick examples. Kiva was an interesting platform that was created by two MBA students traveling in developing countries. They kept meeting entrepreneurs who needed access to $100 or $200 to set up a bike repair business or to start manufacturing clothes. And they were able to lend that money face to face and realized that if they could intermediate those loans through a website, then it would create enormous access to capital for these organizations. So if you sign up to Kiva, you can lend money, you get that money repaid. The repayment rates are above 95%. And within a couple of years of starting, Kiva had lent over $180 million to support entrepreneurs in developing countries and intermediating those transactions. So a very powerful platform and a pretty simple intervention, perhaps one that very few people would have believed might have worked, but the relationships are strong and the entrepreneurs have a profile, and in a sense, this is the same sort of driving effect that organizations like Airbnb have. They connect buyers and sellers and take out the middleman or middle person. They create capital pools that are inaccessible for small-scale entrepreneurs. From a critical perspective, they allow households to generate self-source income and potentially move on the path towards, out of pure subsistence income. And it can expand the range of goods and services in emerging economies, much as leadership of people like Mohammed Yunus have in microfinance in countries like Bangladesh. Second example is one of my favorites in terms of an impact investment. In many countries around the world, people still rely on kerosene lanterns inside the house, all kinds of negative health effects from air pollution, high risk of fire, expensive products. And again, two MBA students started D-Light, taking a very simple solar-powered lantern that would sit outside during the day, charge up a battery, and then provide light inside the house at night. What the second sort of layer of innovation here was that they realized that many of these families didn't have the capital to purchase even a $30 or $40 lantern up front. So they created a pay-as-you-go system where the lantern had a GSM chip, so it's connected to the sort of rudimentary cell phone networks, and people were able to pay for the lantern over 6 months using cell phone credits, that sort of informal banking system that's emerged in many countries through companies like M-Copa. So at the end of that 6 months, instead of buying kerosene, you bought a lantern. That lantern can work for 5 or 6 years, and it has a transformative effect on indoor air quality, or children's ability to work in the home in the evenings. They started out with about $22 million of growth capital in 2016, and they set the goal of reaching 100 million people by 2020, which they were able to reach. So a pretty a rudimentary technology, but a transformative innovation. And again, led by, was glad to see bright young graduate students from MBA programs taking the lead in these kinds of things. So I'm going to touch quickly on the driving forces, and I am going to go through this quickly so we can talk about more of the trends. I'm very happy to follow up with people if they'd like more information on this, but I've identified 4 different driving forces that I think are the key drivers of impact investing. One is, as Paul Collier, a colleague at University of Oxford, has documented, is that the aid system, the global aid system to lift up and raise the fortunes of the poorest billion people in the world, has made very little progress, particularly in Africa and sub-Saharan Africa. While we've seen sort of pretty dramatic transformations in China and Asia, the dependence on aid and the impact of aid in some countries has been considered negative, distorting foreign exchange and enhancing corruption within those countries. And so we've seen a sort of failure of aid on a large scale to lift the hopes of the poorest people within these countries. We still see life expectancy there of 55 years versus 67, high rates of infant mortality and high levels of child malnutrition. So, when Gates Foundation and Skoll Foundation have engaged as impact investors, they've tried to develop alternative business models, different ways of using philanthropy, and get away from some of the worst impacts of aid. And that's been a big driving force, and organizations like Acumen have been real leaders within this space. The second driving force is the sort of changing nature of philanthropy, particularly in the US, where there's over close to $700 billion of capacity in foundation endowments. There's 2 things that have, by my observations, that have happened here. The first is that there's a generation of younger philanthropists who became wealthy in their 20s and 30s. You could think of the Zuckerbergs or the founders of Google, or even Microsoft, where they became wealthy still in the midst and peak of their sort of innovation capacity. There's obviously some strong tax interest in building philanthropic foundations, but there was this very strong view that philanthropy needed to move beyond charity and into this mode of building, creating, in a sense, business solutions to social and environmental problems, and making investments on that basis. So that's been a key driver. We can see some of the trends even in 2015. $370 billion donated in the US to foundations. That numbers continue to grow. But the second factor is returns for foundations in many cases, with a conservative investment approach, have been challenging for them to maintain. So with a $100 million foundation, you may make, with a conservative investment strategy, 5 to 7% annually, which will give you $5 to $7 million to play with, to grant out for these organizations. And what many endowments realized is, if they could make investments that generated comparable rates of return from the endowment itself, so that then they could deploy up to $100 million a year into those causes. So this is what's called mission and program related investing. So instead of just granting, you have the flexibility with your endowment to make investments from the endowment pool, not just from the granting pool. And that's been a very big sort of multiplier and driver within Canada. Foundations like McConnell and Inspirit Foundation have gone this route and embraced the idea that their endowment, their capital in the endowment, can be used for social and environmental purposes. So that's been a pretty powerful driver as well. The third driver, it's always sort of pinned down. I think because I'm so far from being a millennial these days that I resent the idea that only millennials can be enlightened. But there is definitely a demographic effect where younger investors are looking for something different, both out of their work, but also out of their philanthropy. And within BlackRock, famously, a 20-year-old staff team created a $200 billion fund within BlackRock based on traditional sort of negative and positive ESG screens. But from an investment perspective, millennials are twice as likely to invest on impactful companies than their parents, and that generation is going to inherit $40 trillion from their parents and grandparents over the next 3 decades. So a massive shift of capital into the hands of people who are more predisposed to make impactful investments. And certainly what we see in my experience with family offices is it's often the second generation or third generation within a family office that looks at the wealth the family's accumulated and feels like they can do something more with it than just traditional charitable donations. Not that there's anything wrong or negative to say about traditional charity, but that second and third generation will often look to see what they can do that's more impactful, and that's been a big driver in that context. And then the fourth is just, we're running into problems in terms of the lack of innovation in government for some of the biggest challenges we face. If we think about the impact of growing rates of diabetes in the healthcare system, it costs Canada something like $17 billion a year. The mainstream health system responds by providing pharmaceuticals and treatments, but very little investment both in the prevention or the reversal of diabetes. So innovative approaches like companies like Diabetes Digital Media in the UK, DDM, have perfected digital solutions that help people manage their own diets, prevent and reverse diabetes, and avoid that trajectory. So there are approaches called social impact bonds, where an impact venture can be paid by the government out of the savings in the healthcare system from preventing and reversing some of these chronic conditions. And again, that's both a source of capital, but it also recognizes that governments as innovators are slow to move and struggle to be agile. And that kind of partnership, and we've seen this a lot in the UK, and the sort of third sector mindset, that partnership can be very powerful in driving change. If you want the sort of touchstone for the state of the global impact investing market, GIN, the Global Impact Investment Network, runs an annual survey. They identified something like $715 billion of impact investing capital that's investing with mission and purpose. Again, to put that into context, just within Canada, there's over $3 trillion of ESG screened capital. So, as a sector, although it's growing very, very quickly, it's the traditional private equity impact investing is relatively small. But if you want to learn more about this, GIN has been the sort of thought leader within this space. Great annual surveys and reports, and particularly for funds over $10 million of capital, as sort of the sort of institutionalized funds and family offices, they're a key source of information. If we break down the GIN numbers a little bit, 77% is in developed markets and 21% in emerging markets. 48% invest in developing markets and 43% are focused on emerging markets. They tend to not overlap. They tend to either be developed market focused or emerging, but not both. What we also find is in North America, it tends to be more domestically focused. In Europe, it's much more heavily weighted towards emerging market investment. The median investment manager manages, this should say 89 million, not billion, but more than 50% manage less than $100 million. So, still on the scale of traditional private equity funds, relatively small on a median and average basis. Split between private debt, public debt, and private equity. 60% target social and environmental returns through their investments. Almost 90% believe that impact is absolutely central to their mission. And the vast majority, close to 90%, believe they're meeting or exceeding their investment goals through their impact investing activities. So, this market sizing has almost doubled every year, and it's a very interesting way to sort of monitor what's happening at scale. I threw this slide in because people always ask me how we show market rates of return compared to impact rates of return. You can see within this graph, both in developed markets and emerging markets, in private equity, typical rates of return 16 to 18%. And so, very much comparable with traditional market rates of return, where that's the intention. As I said before, some impact investors deliberately seek to go into hard to reach areas where they know their returns are going to be lower, but they know their environmental and social impact can be much higher. So some of the challenges that we've seen in impact investing, and I'll just touch on a few of these here. From experience of sitting on boards of funds and advising companies, that the traditional venture capital model looks to make multiple investments and assumes that a small number of them will achieve that sort of J-curve hockey stick growth. And the reality is, in the impact investing sector, it's much less likely that you're going to find companies that achieve that kind of growth and have that potential for a large scale exit. In fact, in many ways, outside of the digital economy and outside of Silicon Valley, many companies, even in the sort of established clean tech space, have struggled to generate those kinds of returns within the 8-year life of a fund. The typical venture capital approach to investing has needs exits within that time frame if it's an equity focused investment, and will often take a sort of arm's length and sort of slightly adversarial approach to investment with their management. And what we think ultimately needs to happen here is the strongest impact investors take much more of a stewardship approach. In many cases with these ventures, you have passionate, technically adept founders with very limited business experience. That's a very common profile of an impact investment. And I believe very firmly that the sort of leadership capital markets need to play in this space is in not just being a source of money, but a source of advice and mentorship, creating access to markets, sharing experience. And that's a very powerful way for executives that are interested in impact investing to support the ventures. We work with many executives who serve as executives in residence and mentors to companies who can obviously bring some capital to the table, but much more importantly, in some ways, can provide their experience and their networks to help these companies grow and expand. Social sector managers, we worry a lot in traditional venture capital about alignment of incentives. In many ways, the incentives problem in true social ventures is taken care of by just sort of intrinsic motivations. This is the only job many of these people imagine they could do. They're extremely passionate about it. So it's not to say you don't need those equity investments or those performance investments, but it's less important than probably in the mainstream sector. And what's very well established through the work of people like Jed Emerson in looking across many of these ventures and the history of them is that many of these companies rely on a blended approach, combining grants, philanthropy with investments on a sort of a continuum up until the stage where companies can access growth stage capital, and that there's been a lot of innovation in terms of the types of financial instruments that are used. So again, traditional funds will just focus primarily on equity-based investments. In impact, we're seeing debt, royalty-driven approaches, and much more flexible approaches to investment that reflects the fact that exits and IPOs could be much more challenging in the social sector. So I wanted to share these 4 high-level trends with you, and I'm mindful of the time and wanting to leave lots of time for questions. I'll share these 4 trends and maybe then very quickly point to what I think is a rapidly growing area that I'm spending a lot of time on at the moment. But the first is a trend I've touched on already, which is that, jumping ahead slides here, that the growth and the volume of private capital into impact is still happening very, very rapidly, but it's still a fraction of the capital that's dedicated to ESG in public markets. So although we can all agree that a $700 billion of assets under management is a big number globally, it's still tiny compared to global public equities and markets. So that's not necessarily a bad thing. It probably reflects the supply of ventures and opportunities in there, but it is what we're starting to see, I think, is interesting is opportunities where public markets and private capital markets can intersect with an impact lens. The second is there's been a lot of attention to impact measurement. So it's become increasingly important not just to make claims about the impacts you're having through your investment, to actually demonstrate and measure that. And so lots of effort is now dedicated to application of SDGs and impact measurement frameworks to these ventures. And the great balancing act here is not to overwhelm small companies with reporting requirements related to impact that are create real capacity issues within the company. It's about identifying theories of change, understanding what difference you want to make in the world through your investment, and then having 2 or 3 core leading indicators that allow you to demonstrate whether you're being successful or not. So impact measurement's been a really interesting area, and it's in many ways it's a kind of balancing act to find that the right level of measurement. The third trend I'm seeing, particularly in the last couple of years, is very strong direct corporate engagement in impact investing. So large corporations taking balance sheet investing, building funds within their company, or being a sort of founding LP into external funds, but doing it as corporations to go beyond corporate social responsibility claims. So in Canada, TELUS, which is the largest telecoms company, publicly traded company in Canada, I think somewhere around $10 billion of revenue annually, decided to set up within their venturing team something called TELUS Pollinator, which is an impact investment fund. I've been working with TELUS Pollinator as a senior advisor since before it was launched. And it's really interesting to see staff and personnel within the company transitioning into, seeing part of the company's role as being making investments into areas that in some cases align with TELUS's mission as a telco, but in other cases are just, thinking about how the company can do good things with its balance sheet. HSBC, coincidentally, also a pollination themed company, created HSBC Pollination, which is initially a $100 million fund to invest in nature-based solutions. So helping HSBC meet its climate commitments by building a fund that will invest in those into those companies. That's a big play, a big point of entry into the space. And 5 years ago, it'd be hard to imagine, large corporations deploying capital in this way and at this scale. And then the last theme, which is something I'm involved in Canada, is starting to think about how we build public vehicles to allow for retail investors and institutional investors with investment restrictions to participate in the public markets. So there's a lot of interest at the moment in designing those structures in a way that can allow for that broader participation of a wider range of investments into impact investments. So really going beyond ESG screening and offering, let's say, everyday investors opportunities to get better exposure to impact investments. I'll briefly mention what's in the balance of the slides here. I think we're going to have to leave time for questions. I won't go through all these slides. We're distributing the slides afterwards. So if you have questions about this in particular, I'm very happy to take questions as follow-up. But one of the sort of booming areas of impact at the moment is mobilizing capital towards funding nature-based solutions. And the basic premise here is 20% of greenhouse gas emissions are coming from deforestation and land degradation, and direct investment into protecting existing, particularly rainforest and tropical ecosystems, and restoring degraded systems is become a priority area in terms of global responses to climate change. So, what's been a market for nature-based solutions of around $100 million, but according to Mark Carney, is going to expand 15-fold over the next 8 to 10 years. So there's an enormous amount of growth and activity now in nature-based solutions. It's one of the key areas I'm spending a lot of my time on at the moment. I can get into it a little bit more in the Q&A, but I should probably pause there and allow us to take some questions. And thank you for your patience.
James, that's brilliant. Thank you so much. So can I ask some relatively simplistic questions to start off with, both in the kind of motivations of investors and then also the types of investments people choose. So, one of the questions that we've had is how do you actually judge? There's so many things you could invest in at this moment. How do you know where do people start? Do they need guidance? Do they madcap ideas, conveniently covered greenwashed projects that really aren't? So where do you start, and how do you do this in a logical way?
Yeah, I mean, when we talk with institutions and with family offices, we go back to people's ends objectives and say, what's the difference you want to make in the world through your philanthropy and through your investing? And start from that sort of very foundational approach. And often, there'll be commitments related to the activities of the company that generated the wealth for that organization, and or just something that an institution or a family office is passionate about. So with Tellus Pollinator, we've been looking at things like food as medicine, educational technology, agricultural technology, as areas that they feel are priorities for them as a company. And in that context, then the idea is you go out and survey the landscape and you understand what the biggest problems are within that space, and what the most viable solutions are. So you do all of this before you start looking at companies, and you work through a sort of process of then screening individual companies down to focus on what you're most passionate about. So that works at the organizational and corporate level. It kind of works well at the individual level as well. I mean, there's a huge range of social ventures that are trying to raise capital. There's more and more intermediate organizations now, like SVX in Canada, that sort of acts as a brokerage and exchange and connects investors with companies and screens and does some due diligence on them. But those are all private investments into companies that may still stay private for a long time, and so aren't always terribly attractive from an investor's perspective if they're not sure how they'll get their money out. So I think you have to start with what you're passionate about and what you're interested in, and then really understand the landscape before you start falling in love with a venture. That's a sort of a reflex many people have fallen into, and what it means is, there may have been a venture on the other side of the country that was already operating, was doing things better, was better founded, had a better thesis, and you just missed it because you sort of got married on the first date, I think, if that's an appropriate analogy. And so I think that logic applies at that level. It also applies at the individual level. So start with what you care about most, and then look at the activities of some of the funds themselves. Look at platforms like SVX, and I think increasingly we're going to see publicly listed vehicles, a bit like sort of ETFs for impact investing, emerging, that will give people a lot more choice.
So that's interesting. So there's a difference between directly investing and then investing through funds. So right. The more sophisticated you are, the more likely you're able to invest in individual businesses and say, I want to choose that, or I want to choose this one. Or are you saying, actually, if I want to do general good, maybe somebody else does quite a lot of the heavy lifting for me, and I'll go to those funds?
Yes, and the challenges for the funds is that many of them will have minimums that are $100,000 to $250,000. So that kind of venture investing is often an exclusive club. It's accredited investors, which is different thresholds depending on the country. So that kind of direct investing through a private fund can often be quite difficult to access. In Canada, companies like credit unions like Van City have offered registered financial products to give access to things, opportunities like social housing investment. And the bank sort of manages the risk on their behalf and provides a fixed rate of return for investing into that sector. So on the retail side, we are seeing a fair amount of innovation. We see some similar things in the UK with banks offering fully registered accessible products, but not typically for venture investing, more typically for sort of safer investments with very low risks of failure. So there are lots of those opportunities offered by banks, and I think that's going to continue to grow. I get most excited by the venture investing, by sort of building enterprises with capital, and that's still largely a sort of wealthy actor or wealthy institution game that has a high cost of entry. And
so taking that a little bit further, if you look at if you're looking at particular ventures, you can take a portfolio approach yourself, or you can go, I'm betting on that one. Obviously, betting on that one takes a huge amount of kind of like faith. And so do you see the different risk appetites, or is it devoted by risk, or is it something to do with mission and purpose?
Yeah, I mean, my personal approach has been to focus on ventures where I know for my impact investing, to focus on ventures where I know as much as I possibly can about the company. So less of a portfolio approach. I'd rather have a 4 or 5 companies that I can be very actively involved in. I'm on the board of a couple of these companies, and I feel like I've got real proximity to it, and I understand enough about the sector. So, as executives, we can, and executives and leaders can lend their time in many different ways, and some could be, opening up doors and networks for sales and retail for these companies. Some can be acting as advisors and board members. Some can just be writing a check. But my preference has always been, don't do the classic sort of what's called the spray and pray model in venture investing. I prefer personally to take a much more targeted approach and really know what's going on under the hood with these companies. And then, I also feel like I can add more value by serving as an advisor and making introductions and using my networks to help them. And it's one of the great things about having taught in business schools for 20 years is, I've got many of us have networks of MBA grads and people that we've met that can be extremely powerful for companies that are looking for to get that early toehold in the market.
So you've also got, and I suppose there's a big series of definitional points here that are coming up from various people. So, you wouldn't necessarily, in this definition of ESG projects, you wouldn't include the likes of BP doing a very sound project that moves away from traditional fossil fuels into something like that. So you wouldn't necessarily look at that. But also, so some of the most interesting stuff that's coming out, and this is Soham's point, that in recent years have been cities and regional governments doing projects that are infrastructure projects that are very much around sustainability, etc. Would that come under the net of something like this, or do you think that's in a different league and a different kind of model?
I think that's, I certainly think that, there's some very interesting work going on at the moment, a group called Bankers Without Borders in Europe that's taking very senior financial advisors and having them work with municipalities to structure, for instance, green transition bonds for green buildings. And I would consider that an impact investment because the mission and purpose is clear and strong. It isn't a need that's being satisfied by mainstream markets at the moment. So there is a need for new forms of capital and innovations and new types of approach. And I would say, that kind of hybrid space is very much in the sort of crosshairs for impact investing. The question is, would we consider investment in a solar utility play now an impact investment, or is that now so mainstream that it's just met by conventional capital? And I tend to think that's no longer really an impact investment because you're seeing agnostic mainstream capital that's servicing those needs. While the environmental impacts are very good, it's sort of, to me, there always feels like there has to be something a bit frontier-like about impact investments. But many of my colleagues will argue with that. The reason it's also challenging is if you start including every form of clean tech investment in it, impact investing sort of loses meaning a little bit and becomes, it starts to look very large based on just counting, what a really traditional sort of large scale real estate plays in the space, as opposed to some of the more innovative companies.
So if you're looking at what people do, but also you're looking at how people do it. So you look at the ethical aspects of this. And so if you're looking at an organization, a small company, things that's got some very, very cool, very, very ESG, ticks all the boxes kind of idea that will make the world a better place. But you then look at the leadership, and the leadership are doing a good thing to make a quick buck or for self-serving reasons rather than making they happen to be making the world better, but not because they want to make the world better, it's because they can make money out of it. Would you draw a line on a project like that because you look at the leadership and go, well, actually it's not being motivated for the right reasons?
I don't tend to look at that. I mean, I'm of the view that if the intentionality is there, like your goal is, let's say, your goal is to distribute micronutrients. I mean, Danone Foods did a project with Grameen Bank to create products that distributed micronutrient-rich yogurt products in Bangladesh. I'm not particularly sure or clear about what their motivations were, whether they were just building their brand, whether it was CEO driven, whether it was strategic. But you can say there was real intentionality there in terms of the goal of making that kind of difference in the world. They had a clear theory of change, and I'm less hung up on whether they just see it as joining a bandwagon where they can also make money if the outcomes are demonstratively positive. And I think if we hold the sort of set the bar that high, that you also have to, you can only do it if you're deeply ethically committed. It seems a bit self-defeating to me. I'd be happy to see people who saw, something like D-Light as just a fantastic investment opportunity, and they'd want to deploy capital into it, because ultimately, it can't just be the early adopters. We need to mobilize mainstream capital, and we have to accept, for some people, their motivations may just be diversifying to see different kinds of returns. And I have no real problem with that. What I do have a problem with is greenwashing and impact washing, where it's a very superficial treatment of intentionality and impact. I think that dilutes the space and is damaging. And that's in a sense, that's malicious, and that is the wrong motivations. That's taking an average or a bad product and trying to pretty it up. And I tend to call that out.
You're right. Okay. So a question from Alison. Impact investing frameworks have been around for a long time, and companies that have been interested in applying them. What's new now? Is this a hype cycle, or is there something truly different than, say, 10 years ago?
Oh, I think I don't think it's been a transformative switch. I just think there's been a steady growth and interest in a professionalization of this market. And it's, the four driving forces I spoke about, it's those are at least part of the explanation. I'm sure there's other factors people could identify that are important and relevant, but it feels to me like a long, steady growth trajectory for the private equity markets. And I think what will be really interesting, is whether there's opportunities for larger scale capital to be deployed into some of these regions. I mean, if we think about the infrastructure and growth needs in Africa over the next 20 to 30 years, with the fastest population growth and massive rates of urbanization, if we find the right business models, we could deploy trillions of dollars into highly impactful ventures that don't increase greenhouse gas footprints, that improve sanitation and health outcomes and solve really pressing needs in some of these parts of the world. And the same is true in Canada. There's a lot of interest in indigenous finance in Canada, and in building an indigenous economy, and in finding new sources of income that align with indigenous cultural values, and that's a multi-billion-dollar opportunity over the next decade.
And that, I suppose, begs my last question, which is, you've given two examples there of where you think things will go next. And in terms of size, scale, and direction, have you got any kind of gut instincts of other areas that will develop?
Well, I think the big bump lift could come. I think the sort of underlying secular trends is the kinds of rates of growth we've seen from GIN each year, which is a 50 to 100% growth annually in the assets under management. Obviously, that's going to be affected by COVID this year, but I think one of the massive step changes will be nature-based solutions, which is part of the reason I'm spending a lot of time on this at the moment. You have a demand from corporates, from governments, for investment that prevents and reduces the causes of climate change as they're related to deforestation and land degradation, and that could be on its own, that could be a $30 to $40 billion market annually, a 15-fold growth in it. So I think that's going to change. I think the biggest potential areas for change will be when some of the most developed countries start thinking about how to defer treatment costs in the healthcare system with preventative interventions. That's always been an area where I felt there's so much you could do by deploying capital in the right way in those spaces. And eventually some jurisdictions will really take that seriously and start to invest in prevention and reversal of chronic conditions in a big way. And again, that's, if you think of the size of health budgets in the UK and Canada, it's the single largest line item in most of those budgets. So,
and you mentioned COVID. Obviously, everything we do, everything we think about has that motif behind it at the moment. What do you think sort of happened over the last 18 months that's maybe moved the dial in this area?
Well, there's a very pressing discussion at the moment around COVID with one of the companies I'm involved in, which is called Gemina Labs. The reality of COVID is going to be vaccinations are going to make a difference in developed countries where they're accessible. We're going to have a huge pool of people globally who are unvaccinated, and the virus is going to continue to circulate in those populations, and it's going to adapt and mutate. And so Gates Foundation has taken the position that low-cost, widespread testing is going to be critical for tackling COVID in those countries. And so, the company we've been working with, Gemina Labs, has a potentially one of the most sensitive tests, if not the most sensitive test in the world, but one that could be manufactured for under $5 a test, and on a very large scale, potentially to do what the Gates Foundation did with malaria testing, which was a 50 cent, half a dollar per test. So I think that's, as we come out of this sort of really pressing acute disaster scenario for COVID, impact investors are going to have to figure out ways to reach the developing markets where vaccines aren't going to reach, frankly. And that's a critical issue for us.
James, it's brilliant. People have been asking, are there going to be copies of the slides, and is there going to be a recording of this? And the answer is yes and yes on the Fred website. I think Sam has just shared the information in the chat box. And as a final thing, apart from thanking James for an incredibly thought-provoking and engaging set of ideas, which is really, to be honest, more of a taster than anything, but virtually on every level of the slide, you want to go down about 4 or 5 clicks to the kind of the ideas behind it. So I'm sure James is there to help us with that. So the slides, as I said, and the recording of this, for those who want to go through it again or might have missed it, are going to be on the Fred website. James, that was brilliant. Thank you. And thank you for being part of our kind of overarching global community. For those of you who don't know Fred as well as others, just want to point out that as well as these individual events, we have a week every year. It's for 10 years was in person. And then last year it went virtual, and this year it is going virtual again. October the 4th to 8th. Supported by ESA Business School, we are holding our leadership forum for that week. If you go again onto our website, we'll have more details, but we've got some truly amazing speakers. And then for a number of hours each evening for a week, we discuss all aspects of leadership. And I think you might find it enjoyable and fun. So please click on the website, have a look at that. James, thank you. Colleagues, thank you. Sam for making this all work. Thank you. And Joe for masterminding everything as the exec director at Fred. It's been brilliant. And we've got one more next month before the forum. And we'll send information out about that as well as the forum itself. Okay, everybody, have a great evening, afternoon, morning, wherever you are. Enjoy yourselves. Take care.
Thank you. Thanks so much.